Okay, everyone, let's talk about life insurance. Starting from today. Okay, so it is a really important concept. It's tested heavily in CFP exam. So you need to know a lot of those. But basically, if you look at the Kaplan's worksheet I prepared for the exam, there are mainly several parts. Right? You need to know what is a life insurance, you need to know how to calculate the premium, you need to know the type of life insurance, you need to know how to calculate life insurance amount needs and taxation of life insurance, and some other options like dividend option or non-forfeiture options. It is important, it's like one whole page that will be tested. Okay. In CFA curriculum, you need to understand really the basics. Like if you take the CFP exam and then go for CFA, you don't even need to study life insurance or any insurance product anymore. Okay, so CFP is more like CPA in a lot of sense. So let's talk about the parties to life insurance contract. It is a contract, right? Anything in finance is a contract. So first of all, we have the insured, right? If you buy insurance, you are the insured. Okay, so right here we use the whole whose life is covered by the life insurance policy. And then the owner of the policy is the person who can exercise the economic right in the policy. So you don't have to. So your wife can buy a policy on you, okay, or your husband can buy a policy on you, right, or your spouse. So you can be the owner, but you don't have to be the insured as long as you have some insurable interest. And then the owner pays the premium. So you can, so in the business entities, right, the company can buy insurance on the several business owners or several partners. So the business will be the owner, and then the partner will be the insured. And then the beneficiary, the person who receives the death benefits, right? So I have some insurance on myself. I'm the owner. I'm also the insured, and my kids and my wife are the beneficiaries. They have orders, right? Primary and secondary. It's fairly easy to understand. So it hedges, okay? It eliminates. No, it hedges. I'm sorry. It hedges. This is pure risk. You cannot eliminate it. You can only hedge against it. It hedges against mortality risk. What is that risk? Risk from dying early. Everyone will die eventually, but you don't want to. It's also called a premature death. It's the same thing, right? Like, so if you're in your 30s, you kind of are the bread owner for the family, and if something happened to you, your family will be in trouble. So that's the risk you are hedging against. Why purchase life insurance? Income replacement. It's like what I'm saying, right? Family must have to adjust its standard of living if you don't have income. However, if you provide them with life insurance proceeds, they can keep their lifestyle. Okay. Provides financial support for dependents, right? So if you dependents, this is the main reason why people buy life insurance, guys. Dependents. Okay. It's pretty straightforward, right? If you have kids, you go to college, and other financial plans, you also want to pay off the mortgage, right? For me, I have a mortgage. If I die, there's no way my wife can pay the mortgage by herself. Or like even if she can, it will be very hard, miserable for her. So what I do is at least I get the mortgage amount, right, included in my life insurance. So if I die, then the house will be paid off. So they don't need to worry about, or my kids don't need to worry about getting kicked out of the house. So there are some other estate preservations related. It can provide medical expense prior to death. So the medical expense can be expensive. Okay. And some life insurance products provide like acceleration death provision. So basically, if you are very sick, and then the doctor can give them some proof that very likely, so this person will die soon, they can kind of pay you the death benefit ahead of time. Okay. disposal, and so, yeah, those are basically the cost to bury, right? Bury themselves. Probate expenses. Probate is expensive. So if you don't have, so whenever you have life insurance, right, you will be distributed. Very likely it's a trust. Very likely we'll put it in a trust if you for estate purpose, and then the money will be distributed using trust law, not probate. Because probate, you have to go to the court, and there are a lot of issues within a will, and people can contest the will, right? And also, life insurance proceeds will be tax-free. Okay, so can also be used to pay the tax. How much do you need? Right? How much life insurance amount do you need? We understand the importance or the reason why we need life insurance, but how much? So that's where this part is probably more like finance. The other is probably more like traditional knowledge. So again, as I mentioned many times, so there are mainly only two things in finance. One is knowledge, the other is logic. So this is probably logic. So human life value approach. So basically, how much is your human life? You like it or not, finance put a price tag on everyone's life. Okay. And then the way they do it is still fairly easy. Present value, just like you value a company, present value of the money you're gonna earn in the future. Certainly, this is you. You need to spend some money, right? We need to subtract the amount of the money the person will spend out of it. It's like net. You can consider it to be like net income. If you consider income statement from companies, right? Revenue minus expense will be net income, tax, and other things related. Also, in this approach, so this approach I kind of I like more because life insurance, from my perspective, provide needs. So you can just calculate, right? What are the needs of your family if you die? Okay. So it includes, right? They need to readjust, and then how much money the surviving spouse needs, education. You want your kids to go to college, right? And college is expensive, and also retirement funding for the spouse. So that's the approach. I will at least test you guys those two approach, okay? And then of course this one and maybe some multiple choice or short answers on this, but for this will be calculation within a case. Okay, capitalized earning approach is a little bit different. We'll talk about capitalized earning approach later. I think they have an example here. So there are some steps, right? Determine earnings, subtract personal expense, determine how many years this person can work. Okay. Future value of the lost income to the family. And then they have some growth rate earnings. So basically, they assume income will grow, right? And then you can discount all those future cash flow back to today. So that's human life approach. The needs approach is estimate cash need the family will require after the death of the insured. So those are the things. Okay, you can always consider more about it. This is when you need to talk to the clients and understand about what they need. That's why it needs, right? And the goals are always the first step in financial planning because you need to truly understand them. You need to know what they need. Okay, and then after that, finance can help you just of calculations. Capitalized earning approach is a modification of human life value approach. There's no need to determine the work-life expectancy. They assume the perpetuity. Okay, if you are familiar with like preferred stocks, life insurance presumed to be at a long-term riskless rate. So they assume a risk-free discount factor. Okay, so you guys see it's all connected, right? Financial planning, corporate finance, investment is all connected. It's all very similar. It's very efficient. It's a very efficient method to determine the approximate amount. Basically, it's fairly easy for you to use. It might not be that accurate. So for example, you only need $100,000 annually. You assume the raise rate. I would say this is growth rate. Okay. Assume that your income will grow 3% every year. Inflation rate is 3%, so these two aligns. It's quite common to assume wage will grow similar to inflation rates. Risk-free rate is 6%. It is a little bit high if you look at the market today. And then certainly the insured, right? The person also consume some, and then they need to pay some tax. So this is the net income provided to the family. Okay, so 50 grand. And then what is the discount factor? They use see 1 point. So they basically use the real rate of return. This is the Fisher's equation right here. Okay, learn this from Finance 311. And then this is basically can tell you how much, like $1.7 million for someone with $100,000. It's quite it's quite accurate. Okay, you can get like 1.5 million. So I get 1 million. So maybe mine is a little bit lower. I probably need to adjust it. But like the discount rate here, and also this might be a little bit different too. So let's talk about types of life insurance. We have universal life, term life, whole life. So you will be like, what's really going on here, right? Again, after taking this class, I don't want you to go and sell insurance. I want you to be familiar with those so that you know what you need to recommend to clients or your family that is in their truly fit their truly needs. Okay. So that's why you will always make money taking classes with me. Okay. Individual life insurance policy, term life. This is I haven't read it, but it's very good for people. I can actually see it. I like this. So if you are young, right? Young and you don't really make a lot of money, very expensive, very good protection. This is pure. If you realize some spelling issues on my writing, don't worry about it. I don't plan to improve it anyway. Pure insurance protection pays a predetermined sum if the insured dies during a specific period of time. Okay. So the protection ceases at the end of term unless renewed. Basically, it's like auto insurance, right? If you have no accident, then you don't get your money back. Okay. Can be leveled or increasing. A lot of times we have leveled. It's just easier for you to budget. Okay, increasing, you see a different variation of your spending. That's kind of hard to plan. Fixed amount may be leveled or decreasing. So again, like remember we have $1.7 million, right? Needs from the previous calculation. However, like when your kids grow up, maybe they don't need that much money anymore, right? Like my kids are very little, but what if my kids are 18? Do I still need $1.7 million when my kids are going to get a job or get a scholarship from a university? Maybe you can decrease this amount, right? So again, it's a contract, right? Certainly for retail side of finance, we don't really have a lot of room to negotiate or customize the contract, but they still have multiple options. It's like a car, right? You can buy a really good trim or you can buy a basic trim. Okay, and then there's no difference. You need to pay if they give you a good trim. You cannot take advantage of it. Most of the times, the answer for young clients, especially with children, especially when you just start a job, your kids are very little, you have a newborn, go get a term life insurance. Okay, trust me. I hope you don't need it, but if your spouse need it, and then they will really appreciate what you did for them. Okay, renewable, whether it can be renewed, right? Most can be renewed without evidence of insurability. And it can be converted. Most can have a provision to convert to whole life or cash value life insurance without evidence. And then waiver of premium. If the premium payer become totally disabled, the premium are waived during the period of disability. Okay, so this is also very common. So if you have no money to pay, and then if you have this waiver, okay, they will waive it for you. You have limitations, right? So what are the limitations? First of all, it's a pure protection, and if you know how much money the premium, right, is a function of what? Of the face value, right? and then your age, right, or your risk. Certainly when you age, your risk of dying is higher, and then your premium can be much higher. Okay, especially if you don't have a level term. Even if you have a level term, it's like 10, 15 years, very common. Like around 30, and then 15 years later I'll be 45, right? And then when I'm around 50, if I want to get another term life insurance, it will be expensive because it will say, look, the probability you die is increasing. Okay, and then compared with when you are 20, 30, the probability of death is close to 0. Okay. So most term policy are left without collection by the insured. This is okay. Okay, you will say, well, most people are stupid, they lose, right? No, they have protection. Okay, this is a protection you again for insurance, right? You never want to make money from insurance. You want to hedge against some risk. Okay, it's good. Actually, I'm really happy for them. Okay, even if it lapses, that's fine. Like I mentioned, if my kids growing up and they get a job, maybe I don't need a life insurance protection anymore. Because I lose so much money in previous years. Yeah, I use that to hedge my risk. So there's no saving component. You cannot be used for permanent insurance needs. Whole life is the one. Okay, if you want to use life insurance to bury yourself, go for whole life. Again, policies, annual renewable term, level term, decreasing term. I have level term, just to let you guys know. You can certainly have decreasing term or others. It's just easier to budget, okay? Annual renewable term, premium increase annually. Basically, it's renewed every year, and then as you age, right, and probability of death is higher. That's why the premium increases. Okay, you have no cash value in this any term life insurance. Death benefit is fixed. If you have 1 million, then it stays at 1 million. Okay, I don't even think they write 1 million anymore. You probably can get like $500,000. Again, I have not practiced those. But the policy I have is like I have 500,000. Okay. Annual renewable, maybe because I had one and then later I want to get more. Annual renewable term. Advantage is pure death protection. Okay, it's not expensive. Provide maximum death benefit for each dollar in premium. Can be converted. Again, it will be costly at old ages. There's no serving component. The premium increases every year. Okay. Let's talk about level term. Premium and level is the same. Let's say maybe $100 every month for 10 years. Okay, so that's easy to understand. Very good for you to budget. No cash value. Death benefit is also fixed, right? 1 million or 500,000, or any other amount you talk to them. Prepay some of the mortality costs early. Only reason why. So this is age, right? When you age, your probability of death goes up, right? Your premium is a true premium. Okay, your true premium should go up like this, right? The only reason why they give you a level is because you prepaid some here, so that you pay less in the future. That's why it's leveled. There's no way they lose money. Okay, you need to pay more than what you truly need to pay. For example, when you are 20 years old, right, age 20, maybe to insure $1 million, you need to have at least only $10 a month, right? However, they will charge you like $30 a month. Okay, so that in the future, like when you become age 40, right, it should be like 50, and then you still pay 30. That's just how they level them. So basically, that's what it says here. Decrease in terms of premium are level throughout the policy. No cash value build up. Death benefit decreases. It makes sense, right? So sometimes you don't need a lot of protection. Just like I mentioned, when my kids growing up, they can find a job. I don't need a lot of protections anymore. So why don't I drop like from 1 million to maybe like $200,000 just for my wife or for the house? Okay. It's not popular, but economically very reasonable. It's very, very reasonable, right? I think this is a good question to ask you guys. I will remember this. Mortgage insurance. Yeah, mortgage insurance is essentially decreasing term. Do you need to buy mortgage insurance? I don't have one. Okay. Because I have enough down payment. I think if your down payment is too low, they will probably ask you to get some mortgage insurance. So you can consider my down payment as their hedge, right? As a cushion they have. What is a better term for them to use? I don't know. Yeah, there should be a better terminology. Level term, decreasing term, advantage premium remain level throughout the term. Death benefit protection. So this is very good. I will try to get it into the question. This maximum death benefit for each dollar can be converted to permanent policy without providing insurability. You overpay premium earlier, and so that you can have less, right? The policy is pre-funded in early years, not serving components. So for temporary life insurance needs, such as education funding, expenses during a grieving process, decrease in term, paying off the mortgage, benefit decreases, premium stays level. So let's talk about universal. Starting from here, it's called, all those have a cash value component, or like sometimes they say a saving component. Okay, but those are not investments. Okay, because I teach investments, I hate to say this investments. Universal insurance offer flexibility because the insured must adjust premium, face value, cash value. The insurer does not direct investment options, even though they say you have some. So we have a universal and a variable. Okay, so I will talk about it later. But universal life insurance, you cannot choose investment options inside. Cash value can be used to pay the premium, so you kind of accumulate some saving components. It's called cash value. Universal Life A is a flexible premium, adjustable death benefit, unbound life insurance. So the good thing about Universal is you have flexible premium. You can pay more or than needed, right? If they say, so certainly they have some minimum they need to pay, right, to meet let's say $100 to protect the mortality, right? And then they say some expenses. So they say $100 a month. You can put down $200,000 at a time. It's fine. Okay, so you can just put the money into it. Why would you do it? Because you don't need to worry about the premium in the future. So the money over there will grow. They have the kind of a growth component. It will make some money for you, right? It will make a percentage, and then the money can be used to pay this. So that's the way it looks like. Universal B, same as Universal A, especially death benefit vary with the cash value. For Universal A, right? So let's say this is your face amount. Face amount, 1 million, right? And then you invest a lot of money in it, the money will grow. So this is your cash value, right? The cash value originally is small, and then later it can grow. As soon as it reaches 1 million, that's your money. All of them are your money now. Okay, you have $1 million. You will terminate over there, you receive your $1 million. However, for Universal Life B, okay, so it will be like this. So this is your cash value, right? It will grow ideally, and then this is your face amount, right? Face amount will grow together with it, so that the gap is always $1 million or like whatever you decided original face amount. So because the death benefit equal to the face amount of insurance plus the cash value, you guys see you have the face amount plus the cash value increases along with cash value. The beneficiary receives the cash value and death benefit. Okay. Variable universal life is a product with investment options. This is where variable means you can choose. Okay. And then it has no minimum guarantee rate of return or interest. It has no minimum. Basically, you choose some investment, whether it's good or not good. You take the risk. But they do have some protections, at least in annuity products. I'm not quite sure whether there should be some right of protection against if you have some loss. It will help you a little bit on that. Then you should direct investment of the cash value into stock, bonds, and then money market mutual funds. All of those you can choose. Advantage, okay. you can decide when and how much to pay. Then death benefit can increase. Disadvantage is the death benefit may decrease if you lose money, right? Or basically you have some investment risk here. I will change to market risk. Investment is too broad. Whole life insurance or permanent. This is another more commonly used, right? Universal and whole life. Universal is kind of for people with a lot of wealth. Okay, they just have so much money that they need to somehow put it under a tax shelter. A lot of people use insurance as a tax vehicle. Okay. Whole life is more commonly for most people, most households. It provides lifetime protection. Whenever you buy a whole life, you know that you will get paid when you die. Okay. You will, if you die at age 100, very sure you can wait until that day they will pay you. If you die sooner, certainly they will also pay you. It's a pre-funded, okay, so you kind of give them a lot of money up front, and then you will fund through your whole life. Cash value increases to face value at age 100 or 120. At age 100, the insurer can receive the cash value of the policy, which is equal to the face value of the policy. Its levels throughout the term of the policy. Regarding death benefits, the premium typically levels throughout the term of the policy. Okay. So you need to pay a lot. It's very similar to term life. Okay, you need to pay a lot of money up front because you can live very long. Okay. So the premium pattern may vary widely from single premium to increasing premium. So you can just give them one-time payment, and then you can cover everything, or you can just pay them premium gradually. Whole life policy have a saving or investment component, just like universal, with earning accruing on the residual of the premium less the cost of the year plus any previous saving balances. So let's look at example. I'm really glad that they have an example here. Otherwise, I kind of want to pull out Excel to show premium 2,000, right? And then your true cost is only $1,200 to insure your mortality, and then certainly they have some costs. This is an insurance company, okay? So they are for profit, okay? They need to make profit, and then you kind of overpay $500. This $500 will earn like maybe 5% return, right? Every year that will equal to $25, right? If you choose some investment, then you will continue. This is called cash value, right? You will accumulate. Then the next month you have another $500. It's like you save some money into account, okay? So that's why they will sell insurance like this is a good investment. Cash value may be used for loans or maybe received if policy is surrendered. If the policy is surrendered, then the insured will receive the cash surrender value. The cash surrender value, the cash less cash surrender charges. So what does it mean? If you surrender, you gotta know, right, what surrender means. So you have a life insurance policy, you have some cash value, and you want to cancel it. You call your insurance agency, I'm not going to do it anymore. I'm good, okay? I'm okay. So can I get my cash value back? Yeah, sure, but we need to charge you some surrender charges. That's what they do all the time, right? And then the remaining will be the money you have. You can also borrow from the money, but you need to pay interest. It's kind of awkward, right? So that's your own money, and then you borrow it, you need to pay yourself interest. However, the interest is going to insurance companies, so that's really good way for them to make money. Okay, cash value usually have a minimum. They will argue. Why they will argue? They will say, if you don't take the money out, I could have used the money to make some return on my side. Is that a good argument? No, it's not a good argument. I paid you already, right? Anyway, cash value usually have a minimum guaranteed rate of interest. Yes, so that's okay. So the minimum guarantee happens only in whole life, not necessarily on universal life. I guess that's what it says. Okay. Whole life policy may be participating or non-participating. So what does that mean? So there are two ways to insure, right? One way would be talk to an insurance company, they are for profit. The other would be find several people like you, and then you organize a group. It's called a mutual style or mutual type. So it's like you have a community, like federal credit union, right? It's a mutual community. And then if they make some money or you overpaid, they will give you dividend back. So that's what it says. So even within whole life insurance, you have various types: ordinary life, limited pay life, variable life. You pay premium until age 100 or death. Premium are higher than ordinary, only pay premium for a specific number of years. So you pay more, okay, and then it will stop. It will cover you until you die. Variable life, cash value is investing in stock, bond, money market, mutual fund. There's an opportunity for higher return. Okay? You choose, okay. You choose your investment, however, you subject yourself to market risk. And the advantages, tax deferred growth, right? The money. So that's why people like Universal and Whole Life, okay. Those people with a lot of money, they want to have their money grow tax-free. Disadvantage, the policy is expensive and it is not necessarily flexible regarding. Then it has some disadvantage, right? It's expensive and you don't really have flexibility regarding premium. It's a gradual cash flow growth and you have to wait a while. You might not be able to purchase as much protection. Again, it's expensive, right? So the only way to make it affordable is you have less coverage. So again, that's why this is not good for young folks. Go back to term life insurance. This is good for people in their 40s. I'm sorry, why I have dollar amount all the time? 40s and 50s, when they have well-established career, they have some savings, they want to have some protection until die. Okay. So they want to have that kind of guaranteed protection. So anyone has insurance needs, estate planning purpose. So if you have permanent life insurance needs, right, until you die, that's called a permanent life insurance needs. Provide liquidity, because it's going to pay you for sure. You will have some liquidity and death. You will have the money to bury yourself. So that's why many people have it. I think we're gonna stop here today.